that is just the phases of how the banana zone tends to play out. You tend to get the first spurt. Bitcoin went from 50,000 to 100,000. It then corrects a bit. Everyone freaks out. I mean, it's ridiculous. I mean, it's literally ridiculous. The people freaking out from a correction like this. And then you usually get the old season part. And that's when any moron can make money, including myself, in anything that you hold. And that is the old season. That usually, in full throttle goes through till, let's say, April. And then it tends to get more selective in the final phase where they concentrate on the key themes.
Raoul Pal begins by breaking down the current market cycle into digestible phases, emphasizing how predictable patterns tend to repeat themselves. He highlights how Bitcoin's initial surge from $50,000 to $100,000 aligns with historical trends, followed by corrections that often cause undue panic among investors. This phase is what he refers to as the banana zone, where emotions run high and noise overtakes rationality. However, these corrections are a natural part of the cycle and often lead to an altcoin season where gains are widespread even among less established projects.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Everybody's asking about, I put a big thread about it yesterday. Has the market topped? What's going on? Is that M2 chart going to play out? Are we all fucked? Is it going down to 75,000? Yada, 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 yada. I mean, it's all day. And then it's like, oh my God, the Fed aren't going to cut rates. That's the end of the market. They can't, just so much noise. What I urge people, I wrote it, I think, in response to you, Ovi, is 2017-16 was a near identical setup. So the market has been following the pattern. But outside of that, Trump got elected. Everyone went, oh shit, tariffs. They're inflationary. The dollar screamed higher. Rates went higher. And then what happened was Trump came in and said, we need to get a lower dollar. Scott Bessent's already talked about it. The other guys coming in as the Economic Council guys already talked about the dollar being a problem. So I think they're using the dollar as the stick and will then offer it as the carrot to the Chinese, the Canadians, the Europeans, and everybody else, which is, if you agree a trade deal with us, we will help lower the dollar. The dollar is a function of liquidity, which is why rates are so bad as well. There's actually not enough liquidity in the system. And I think that's sort of somewhat purposeful overall. But if we go back to 2017, and we had that setup of the dollar turning over and then rates actually came down for the rest of the year. The other thing, the Fed were raising rates all of 2017 and crypto went up.
Yeah.
US M2 went down. So all of the things you would be looking for, they were all in reverse. So what really was happening in 2017 was China had been beaten up by the strong dollar in 2015, 2016, and their economy was super slow. China increased the balance sheet and the Fed lowered the dollar. The Europeans did some QE and the UK did some QE. We got a near identical setup. The market is over extrapolating tariffs and fears. Whatever rates do is irrelevant. It's what global money supply does, not global money supply, global liquidity does going forwards. We know back in 2017, the Treasury drained the TGA for the same reason. I mean, it's like literally everything is an exact rerun of what happened. So look, I don't expect an exact rerun this time, but probabilistically speaking, there's nothing to be concerned over. Now, when we looked at that big M2 drop last time around, and this time around, it leads by about 12 weeks. So last time around, we had an identical M2 drop. You can see it. I don't know if you can share that chart you're looking at now after that one. So this one shows the near identical pattern in M2 back then versus now. What happened was the dollar weakened, global M2 went up. What also happened is the NASDAQ had a similar correction, crypto very similar. And what crypto did was didn't follow M2 going forwards because it starts to decouple as the bull market takes place. And what happened was it did an 8-day correction and did negative 35%. This time it feels like it's slightly more sideways. Whether it goes a bit lower or not doesn't really matter. But the point being, you're looking for the bottom as opposed to a sharp acceleration from here. But either way, it's over pretty quickly. And then what happened last time around is the moment Bitcoin hit a low, alts took off. And so that's my general thesis on all of this right now. This is pretty much playing out exactly as I've been expecting it to play out. And whether that's in liquidity terms, because it's a rerun, because we've got this debt cycle, it's the same bloody thing, right? So that's my overall view. It's like, it's all fine. It normally decouples at this point in the cycle anyway, because it starts forward looking. Now, liquidity is actually financial conditions drive liquidity. And so crypto has been following financial conditions. So it suggests that liquidity comes back. So, but then in the full bull market phase, it normally does decouple. So I don't think it's doing anything unusual whatsoever. And, you know, we're now a $3 trillion asset. You need more institutions in to drive the asset higher anyway. You know, people forget that. Like, the institutions here, it's amazing. Well, it has to be. If you want 100% rise, you need larger pools of capital now because it's a much bigger market. So, and over time, I think, yes, we get product market fit. I don't think AI is the product market fit currently. I think that's all narrative based versus the reality of where it is. But look, overall, the trends are all right. And we haven't even got the bloody administration in yet. We haven't got the clarity that we're all waiting for. And everyone's at kind of a max fear right now. It's crazy. But that's a good setup, right? It's just a good setup for the year.
Raoul also touches on the geopolitical dynamics influencing markets, particularly the interplay between the U.S. and China. He explains how China's inability to stimulate its economy due to a strong dollar echoes the challenges it faced in 2017. The solution, as before, lies in a coordinated effort to weaken the dollar, which would allow China and other economies to inject liquidity without destabilizing their currencies. This geopolitical chess game, he notes, is a critical factor in the broader market narrative. The U.S. Treasury's decisions around liquidity injections and dollar policy will play a pivotal role in shaping the economic landscape over the coming years.
I think the business cycle is still not above 50. It will go above 50. That means corporate earnings go up, and then we get rid of that bifurcation between the tech stocks, which are cash flow driven, zero debt, and the regular economy. That gap closes because earnings grow. Earnings grow, household earnings grow. Household earnings grow, investment goes into markets. So that virtuous cycle is all the same cycle across all assets. The next phase of this, we will see the cyclical plays, the commodity plays, all starting to rally as the global economy starts to recover. So that's all to come. The ISM is still below 50. I think the Fed will continue to cut rates, and that's okay. But really, it's down to the US injecting liquidity to weaken the dollar and jawboning it lower. Because if the Fed come in or the Treasury come in and say, you know, we believe in the strength of the dollar, but it's too high for growth right now, whatever, that's enough to turn market participants nervous. And then all you need to do is inject liquidity through various mechanisms to force that to happen. Don't forget, we got a $700 billion drain of the TGA to come as well. We've just drained the reverse repo. So they're going to have to stop QT as soon as they finish the reverse repo, which will be by kind of Feb, maybe. So then you're ending QT, injecting liquidity from the TGA. They've already mentioned, who was it? I can't remember who it was. I think it was Powell at the last Fed meeting said, we don't want to have to tighten liquidity on the rebuild of the TGA. That was a signal everyone missed. He said, we understand draining the TGA is liquidity into the system, but we don't necessarily want to tighten again once we have to rebuild it. So that's telling me it's probably QE. Now, maybe it's not QE, maybe it's QE by a different name, but I think they all know the game. The other thing that's interesting about this cycle is the best indicator for almost everything in the world is the ISM survey, you know, the business cycle. the ISM is still not above 50.
Yeah.
And, back in 2017, it had come 50, but by about March, it really started accelerating. So we haven't even had a business cycle yet. Now, what's interesting is the best indicator of when you should be looking for a top in crypto is when the ISM is peaking, because that's when liquidity starts changing. Now, that happened really early in 2021 because of the pandemic. So it happened in March 2021. 2017 didn't happen until the end of the year. I think because ISM has been so low this year, there's a chance that this thing doesn't peak until Q1 2026. So it's a slightly different cycle, but we're just not even in the ballpark of looking for a larger top. The China game here is really clear. They cannot stimulate because the dollar is too strong, and they'll break the lower bound of the yuan. Right? They just can't do it. It's exactly what happened back in 2017. What they need is the US to weaken the dollar, then they can stimulate. They know it, everybody knows it, Yellen knows it, Scott Bessent will know it. That is the game. And the game is, we will not give this to you until you agree tariffs. And then they'll give it to them. And that's exactly what Trump did last time. So really, they will stimulate massively. They have to. They've got a full-blown debt deflation going on. But they can't do it without losing their currency.
As Raoul concludes his analysis, he emphasizes the importance of looking beyond short-term noise. While fears around rate hikes, liquidity drains, and other macroeconomic factors dominate headlines, the broader trends remain intact. Markets are poised for recovery, driven by increasing liquidity, institutional participation, and the natural progression of the business cycle. He also highlights the potential for cyclical plays, such as commodities, to rally as the global economy recovers. For investors, the key is to remain patient and focus on the larger picture, rather than getting caught up in day-to-day fluctuations.